Hello everyone, hope everyone is good. This is your AFM facilitator Mudassir Hussain here. In today's video, I am going to discuss some Excel tips for your AFM and FM exam. Most of the students they were asking me, sir, please make a video that how we can use the spreadsheet functions. So in this video, I am going to give you people a know-how that how you can apply these formulas. So let's start one by one. First of all, everyone, you know that if you have to discuss a question on the NPV analysis, so first of all, we start with the years, like we have year 0, 1, 2, 3, 4, and then 5. We take the sales, then we have the variable cost, incremental fixed cost, then we deduct the capital allowances. Then we have the taxable cash flow. Then we apply the tax. And then we add back capital allowances. Here we are deducting, here we are adding back. Then we have initial investment. Then we have scrap value, working capital, and there will be your net cash flows. For example, let us just assume that this cash flow is 1000, this is 500, this is 500, 400, 300, 200, and 100. Now let us assume the discount factor is 10%. Now one previous method which you can follow, you will apply as this discount factor is 10%, so it will be 1.1 raised to power minus this one. Whatever this is coming, just copy paste it into the next cells. And now you can compute the present values. How you will compute the present values? This multiply by this. Just copy paste. And now if you have to calculate the NPV, just sum all of this. This is the NPV which is coming as 209. But now, as the examiner has mentioned that you have to apply the spreadsheet functions, guys. So for apply the spreadsheet function to compute this present values while applying the discount factor for each year, this is time consuming and you cannot get the marks for your one of your professional skills. So examiner has mentioned you have to apply the spreadsheet functionality. Now see again, I am computing this NPV with the help of the spreadsheet functionality. What you will do, guys, you will type here NPV bracket open. It is telling you to choose the rate. Rates chosen must is the 10%. Then you will select the values, the positive value starting from your 1. This is bracket close. Then add the initial investment or your year 0 cash flows. See guys, this is giving in the percentage, yes, in the journal. So why this answer is going as wrong, guys? Because I have taken the present value, the mistake I have done. Here you have to take the cash flows, not the present values, guys. See, let me again do for you. The mistake I did, the 10% was the rate, comma, select this cash flows starting from year 1 to 5. These are the cash flows. Then close the bracket and add the year 0 cash flow. See guys, the same answer is coming 209 and 209. Now, if you have to get the marks on the professional skills, so you have to follow this strategy. You have to go through this. So the first method which you can adopt, that is the calculation of this NPV analysis with the help of the spreadsheet functionality. Now, the second technique which we are going to learn, that is known as the IRR. Now see guys, in the previous method which we follow, you must be having the 2 rates and the 2 NPVs. Like at 10% NPV is coming as positive. For example, let's choose another rate. That is, for example, now we choose the discount factor 20%. Now at 20%, you have to again compute the working. So guys, for this 20%, what will happen? You have to perform the working. So it will be 1.2 raised to power minus this. It's coming as 1. Just copy it into the next cell. Now calculate again the present values. So for the present value, this discount factor multiply by the cash flow and copy the figures into the next cells. Now to get the net present value, again apply the sum formula. This still the NPV is still coming as positive, guys. So it's mean again we have to increase the rate by more percentage. Again, this is the time consuming thing. Let us assume instead of 20, let's assume we assume here the rate as 25%. Now this value will be changing. Definitely. Now it will be 1.25. This one, copy, paste on the next cell. Now see guys, this value is coming as a negative. Now, to apply the IRR formula, if you have to go for the IRR formula, so previous formula was you take the lower rate, that is how much? 10%. You add lower rate NPV, that is this. You divide by the lower rate NPV plus high rate NPV multiply by higher minus lower rate. So higher minus lower rate, the higher rate is 25%, the lower rate is 10%, and you can compute the figure. So just in the percentage form, it is coming as 34%. It is a very time consuming process, guys. So now, just to be on the safer side, if you have to apply the IRR, just type is equal to IRR is equal to IRR. This is the formula. Take the values, all the cash flows from year 0 to complete years. Close the bracket. It is giving you the 20% value, which is more authentic answer, guys. Which is more authentic answer. The previous answer which you have calculated, that is a wrong answer. And why that answer was wrong, guys? Because this value is being added. In the original formula, see, this is plus. This is not being actually plus. You will tell the examiner if we are applying here. See now, because in the original formula, what is going to happen? In the original formula, the IRR formula is lower rate multiply by NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. So guys, when we actually perform on the calculator, this minus minus get plus. That's why we add. But here, as the Excel is doing the calculation, so you have to perform the calculation like this. But as this is a time consuming process, so simply you will apply this IRR with the spreadsheet function. That is more value adding for you people. Now the third technique which you have to apply in your AFM course, that is the MIRR. For the MIRR, there is a formula. Present value of return phase divided by present value of initial investment raised to power 1 over n minus 1. And there is another formula as well. So just you will apply MIRR values. Again, have the values, the net cash flows. It is saying to finance rate and investment rate 10%, comma 10%. Close the bracket. This is giving you the MIRR. Instead of going through a complex formulas. Now, understand guys, We have computed the NPV, IRR, and MIRR. Now we are going to learn the next one. If the examiner is asking you how to compute the discounted payback period. Now for this discounted payback period, first of all, you will be having the years. So guys, for the year, just use the link. This is the link. Copy it and paste. Now type here the cash flows. So I am straight forwarding, applying the link. These are the net cash flows. Now, as this is the discount factor, guys. So apply here. For example, the discount factor is 10%. So it will be 1.1 raised to power minus this one. Copy and paste. These are the values. Then you have the present values. This, copy, paste. Now the last column which you make, that is the cumulative cash flow column. The cumulative cash flow, this will be as it is in the next. This plus this. So just apply this. Now copy and paste in the next cells. Now see guys, what is going to happen? This discounted payback period is in between second and the third year. Because in the second year, the cash flows were negative, but in the next year, these are going to be positive. So you will take the 2 years complete. And for this, you will have 214.9 divided by 225.4 multiplied by 12. So guys, this is 2 years and 11 months. So guys, this is your payback period, discounted payback. Now, the next calculation for the topic is known as the duration. For the duration, you will again have this link, copy, this one, and you will have the present values, guys. What you must be having, the present value. These are the present values. Just create the link, Now there must be having a total of these values. Apply the sum formula. The present values of the inflows, not the outflow. Now, first of all, you will calculate here the fraction. The fraction formula will be this divided by copy paste for the next year. Okay. You can do it by yourself as well. This divided by this. Then for this divided by this. This divided by this. This divided by this. Number third step is to compute the weighted average. For the weighted average, you will multiply this figure with the respective number of year. Like you can do this. This multiply by this. Just copy and paste. Now this will be the deviation. Add up all these figures. This is the duration 2.19 years. So we have gone through the NPV, IRR, MIRR. We have gone through the discounted payback period. We have gone through the duration. Now we are going towards the calculation of for example, now we are going to have the calculation for the market value of the redeemable debt, the YTM of the redeemable debt, or the KD of the redeemable debt. Let's assume par value 100, coupon rate 10%, YTM is 8%. The first requirement is we have to compute the market value of the bond. So guys, we will type here the years. The years we have already this one. So copy, paste. Now, every year you will get the interest, and in the last year, interest plus principal. Now, how you will do that? In year 0, there will be nothing. Now, guys, you will take this, multiply by coupon rate. So this you will copy and this. So every year you will be having this value. Then, but in the last year, remember guys, you must be having the redemption value as well. That is 100. Now apply this YTM as discount factor 8%. Now it will be 1.08 raised to power minus 1. Apply this figure into the next cells. And now to get the market value, add up all the figures. Sorry, first of all, you have to get the present value. This one, copy, paste. Now to get the market value, apply the sum. This is the market value of the bond. This was the duration. Now, simply, just to save the time, you can again calculate. If the requirement is the same, like this is the requirement, and now examiner is saying compute the YTM. Examiner is asking what is the YTM. Market value is given to you, for example, in the question that is 108. So guys, remember, we have studied already. You will apply the IRR method. In year 0, you will place the market value as negative. Now, every year, you will take the cash flows. These cash flows we have already taken. But remember, the cash flows, you are starting from year 1. This you will take. Now, these are the cash flows. Guys, just apply the IRR method. Values. This. All the values. %8. This is the YTM. Now, if you have to compute the KD, let's recopy this example. But now, instead of the YTM, examiner is asking you the cost of it. Now remember, only the difference between the YTM and the cost of debt was the YTM. You will always take the pre-tax interest. In this, you will take after-tax interest, guys. In the cost of debt, we always take the after-tax interest. Again, you will be having years. This, this. But remember now here, this will be, for example, let's assume here the tax is 20%. Now, in year 0, you will place market value. Example, negative 108. Now the cash flows will be. Now see, previously we were getting 10, but now it will be 10 multiplied by 0.8 because we are after taxes. Just copy, paste. But in the last year, you are also having 100 redemption. Now guys, again apply IRR, select all the cash flows. This is your kid. So guys, up to this point, what we have done, we have gone through the various calculations for the cost of debt, for the YTM, and for the market value of the redeemable bond. So guys, in this video, we have gone through the maximum formulas which are being testable by the examiner, the NPV function, the IRR function, the MIRR function, the discounted payback period, which is this. Then we have gone through the duration, then the calculation of the market value of the redeemable bond, then the YTM, then the cost of debt. Now, for example, in your exam, the examiner is also asking to gearing and ungearing with the help of the betas. For example, you have been provided the beta equity, that is, for example, 1.5, market value of equity 1000, market value of debt 500, tax is 20%. Examiner is asking you to find out the value for the beta asset. This is the requirement. Now see guys, you know that what is the equation? The equation I am putting here, it is beta asset is equal to beta equity multiplied by value of equity divided by value of equity plus value of debt into 1 minus t. This is the formula, the main formula. Just put on the figures. We have to find beta asset. The beta equity is this one. Multiply by the value of equity divided by bracket open. Value of equity, how much? 1000 plus value of debt is this one. Then with this figure, we have to multiply by 1 minus t, and that will be the 0.8. So guys, this is the beta asset calculation. Now just reverse the things. Now, for example, examiner is saying to you that this is the beta asset. And now we have to perform the calculation for beta equity. Now this is the requirement. This was the beta asset. This was the beta asset. Now we have to find out the beta equity, guys. Now see, the question is in front of you. You have been provided the beta asset and that is 1.5. You will take this. You will divide it with the value of equity, that is 1000. And then you will multiply this figure with value of equity and debt. So value of equity was this, value of debt was this, multiply by 0.8. I mean, we are doing the reverse calculations now. So this is coming as 2.1. So guys, this is the beta equity. And this was the beta asset. So guys, these are the major formulas which are being used in your exams. So I hopeful that this video is useful for you. So if you really like this video, please like and subscribe my channel as well to get the more updates. Thank you so much. Registrations are open for June and September sessions. So for the demos, you can also inbox me. Thank you so much. I'm also having my website www.elitelearningprovider.com. You can also visit this website, guys, to have a link of the classes. Thank you so much, guys. See you people. Bye bye. Take care.